A couple opens their banking app on a Sunday morning. Combined income $160,000. Savings $52,000. Debt manageable. On paper, they're doing well. They're looking at a house listed for $495,000. 3 bedrooms, nothing special, just normal. And the numbers don't work. Not because they're bad with money, not because they're overspending. The math just doesn't close. This video isn't about how to afford a house. It's about why math breaks for people who are doing everything right. I'm Aria, and this is Aria Invest. We don't give financial advice. We don't tell you what to buy or what to do. We explain how money works structurally and psychologically so you can think clearly about your own financial reality. Today, we're looking at a $500,000 house, not as a goal, not as a dream, just as a math problem. Because in dozens of U.S. markets right now, $500,000 is what normal housing costs. And when you reverse engineer who can actually afford that, the answer is uncomfortable. Here's the context. In cities like Denver, Austin, parts of the Midwest, and most coastal suburbs, $500,000 doesn't buy luxury. It buys average. A 1,200 square foot house, 3 bedrooms, maybe a small yard. The median household income in the U.S. is around $84,000. That means the market is asking median earners to buy homes that cost 6 times their annual income. Historically, a healthy ratio was 3 to 4 times income. At 6 times, you're not stretching. You're operating outside sustainable boundaries. But people are still buying. Banks are still lending. So something must be working, right? Not quite. What's working is approval. What's not working is affordability. Let's start with the entry cost. A traditional down payment is 20%. On a $500,000 house, that's $100,000 in cash. The median savings account in the U.S. holds about $8,000. That's not a small gap. That's a structural gap. If a household earning $84,000 saves 10% of gross income, which most don't, they're saving $8,400 per year. At that rate, saving $100,000 takes 12 years, and that assumes housing prices stay flat, which they won't. So most buyers put down 5% or 10% instead. On a $500,000 house, a 10% down payment is $50,000. That leaves a $450,000 loan. But lowering the down payment doesn't lower the cost, it shifts it. You now pay PMI, private mortgage insurance, which adds $200 to $400 per month. This is a fee you pay to protect the bank, not yourself, because you didn't have enough wealth up front. It's not a loan term, it's a penalty for not being wealthy. Let's assume the $450,000 loan at a 6.5% interest rate. Monthly mortgage payment, approximately $2,850. That's principal and interest only. Now add property taxes, $500 per month, conservative average, homeowner's insurance, $300 per month, maintenance reserve, $417 per month, 1% of home value annually, PMI, $300 per month, total monthly housing cost, $4,367. Not aspirational, not the worst case scenario, just standard. Now, here's where the psychology shifts. Financial guidelines say housing shouldn't exceed 28% of gross income. Banks will approve you if total debt stays under 43% of income. If $4,367 represents 28% of your income, you need $187,000 per year. If we use the looser 43% threshold, you still need $150,000 annually. Only 10 to 20% of U.S. households earn that much, which means 80% of households cannot comfortably afford a $500,000 house under rational financial standards. But the houses are still selling, so who's buying them? Let's track a real scenario. 2 professionals, combined income $160,000, well above median, upper middle class. After federal tax, state tax, FICA, and modest retirement contributions, take-home pay is roughly $9,500 per month. Subtract the $4,367 housing cost, remaining $5,133 for everything else. 2 car payments, $800, auto insurance, $250, gas, $300. Student loans, $600, health insurance premiums, $400, groceries, $800, utilities, electric, water, gas, internet, and phones, $450, remaining $1,533. That's what's left for clothing, medical copays, car repairs, kids' activities, emergency savings, and any discretionary spending. This household is spending 46% of take-home income, not 28%, nearly half. And these aren't financially reckless people. They're not buying luxury items. They're not overspending on lifestyle. They're just living in a house the market told them was normal. Here's what this feels like in daily life. It feels like checking your account balance before buying groceries. It feels like saying no to small expenses, not because you don't value them, but because you can't absorb variability. It feels like lying awake running mental scenarios. If the HVAC breaks, if someone needs braces, if the car needs new tires. It feels like being one unexpected cost away from financial disruption. A $5,000 HVAC repair, a $1,000 insurance deductible, financing dental work like it's a car loan. This is the reality for households earning $160,000 trying to own a $500,000 house. Now imagine households earning $120,000 or $100,000 or the actual median of $84,000. At median income, a $500,000 house isn't tight. It's not even stretching. It's mathematically impossible without external help or accepting catastrophic financial risk. The housing market doesn't care about these numbers. Sellers list at $500,000 because comparable homes sold for that. Banks approve buyers at 43% debt to income because the loan technically won't default immediately. Real estate agents encourage buyers to stretch because their commission depends on closing. Nobody in the transaction has an incentive to tell you that you're about to drown financially. The system is designed to get you into the house, not to ensure you can live in it long term. And once you're in, once you've signed, moved, committed, you're locked. Walking away 6 months later destroys your credit and loses your down payment, so people stay. They stay in homes they can't afford, working jobs they can't leave, slowly draining reserves, wondering why they feel so much stress while supposedly living the dream. Here's the uncomfortable reality. For 70 to 80% of U.S. households, a $500,000 house isn't affordable, not sustainably, not without accepting financial precariousness that previous generations would have called reckless. This isn't about personal failure. It's not about discipline or financial literacy. It's about a structural disconnect between housing costs and income growth. Since 1990, home prices have increased roughly 400%. Median household income has grown about 180% in the same period. The gap isn't closing, it's widening. And yet the narrative persists. Home ownership is essential for wealth building. Just budget better, skip unnecessary spending, work harder. But you can't budget your way out of a structural problem. You can't side hustle into a down payment when rent consumes 40% of income. You can't manifest lower interest rates through discipline. What you can do is understand the actual numbers so the decision you make is informed, not emotional. Let's be direct. If your household income is below $140,000 and you're looking at a $500,000 house, the math doesn't support it. Not what the mortgage broker says you're approved for, not what the agent says is normal, not what your peers appear to be doing. The numbers are the numbers. Approval and affordability are not the same distinction. Here's what happens when people ignore this distinction. Month 1, the payment clears. It's tight, but manageable. Month 2, same. You adjust. Cut discretionary spending, skip the gym membership. Month 4, the car needs brakes, $800 unplanned. Every dollar is allocated, so it goes on a credit card. Month 7, the AC fails in summer. Repair quote, $3,500. You don't have it, you finance it. Month 9, one income stream drops. Hours cut, freelance contract ends. Suddenly, you're $600 short monthly. And that emergency fund you planned to build, it never materialized. There was nothing left to save. This is what being house poor looks like. You own the house, technically, the bank owns it for 30 years, but you can't afford to maintain it properly. You can't afford to live in it comfortably. You definitely can't afford to enjoy it. Every unexpected cost becomes a crisis. Every decision filters through one question: can we still make the mortgage? You become a prisoner to an asset you're supposed to own. Here's what makes this truly insidious. Because housing affordability is so widespread, we've normalized the stress. We've rebranded financial desperation as adulting. House poor? That's just home ownership. Can't furnish 3 rooms? Part of the journey. Eating cheap meals because the mortgage consumed everything? You're building equity. We've collectively agreed to treat struggling with basic homeownership as a rite of passage, not a symptom of systemic dysfunction. The math is screaming, but culture keeps whispering, buy anyway. Your parents bought it at your age. Their house costs 3 times their income. Yours costs 6. Your friends are buying. You don't know if they're drowning behind that front door. Society says renting is throwing money away. So is defaulting on a mortgage you can't afford. Here's what you're allowed to do. You can look at a $500,000 house, run the real numbers, and decide it's not worth sacrificing financial stability, mental clarity, or long-term wealth-building capacity. You can keep renting while you save. You can wait for market conditions to shift. You can look at smaller homes or different markets. You can acknowledge that the version of home ownership being sold to you has become unrecognizable from what it was designed to be. And that's not failure. Because here's what actually builds wealth: margin in your budget, consistent investing, not choosing between roof repairs and retirement contributions, sleeping without financial anxiety. Real wealth isn't equity you can't access because you're trapped by the asset that's supposed to free you. Real wealth is freedom. The financial system profits when you buy, not when you make smart decisions. The bank makes money on your 30-year loan. The agent makes money on the sale. The insurer makes money on the policy. Nobody in that system profits when you say, "This doesn't work for me." If you're sitting here feeling priced out, feeling like homeownership is slipping away, feeling like you're failing at some fundamental milestone, you're not failing. The system is failing you. Home prices have outpaced wage growth so dramatically that what was normal for previous generations is now a luxury item for most people. A $500,000 house is not a starter home. It's not affordable on median income. It's not something you stretch for unless you genuinely have the income to support it without financial acrobatics. So run your real numbers. Factor in all costs, not just the mortgage. Be honest about income stability. And if the math doesn't work, walk away. There's no shame in saying, "This doesn't make sense for me right now." There's no trophy for buying a house that makes you miserable. The real win is making decisions based on reality, not social pressure, on math, not emotion, on your actual financial situation, not what you wish it could be. This isn't about giving up on homeownership forever. It's about giving up on the delusion that a $500,000 house is within reach just because a bank will approve the loan. Bank approval and your ability to live a stable life are not the same calculation. Maybe in 5 years your income doubles. Maybe the market will correct. Maybe you relocate to a market where $500,000 buys something reasonable instead of a leveraged stress position. But right now, today, with current prices and incomes, this math is broken for most people. And pretending otherwise doesn't make you optimistic. It makes you vulnerable. Stop looking at what you qualify for. Start looking at what you can genuinely afford without turning your financial life into a tightrope act. Find the number where you can pay the mortgage, handle maintenance, save for emergencies, invest for retirement, and still occasionally live without money-related stress. For most people, that number is nowhere near $500,000.
And that's completely fine. You're not less successful for being realistic. You're not failing at adulthood for refusing to drown financially. You're just doing math that most people won't. The housing market will keep pretending these prices make sense. Banks will keep approving unsustainable loans. Agents will keep saying it's a great time to buy. But you don't have to participate in collective financial insanity just because everyone else is. Sometimes the smartest move is recognizing when the game is rigged and choosing not to play. We publish one of these every week, each one designed to help you see the system more clearly. If that matters to you, subscribe and share this with your family and friends. And if someone you know is still caught in the cycle, send them this.